Hey, good morning, options traders. Well, I just wanted to slip in a quick, unexpected video with a good question. What happens if your loan percent is repriced? And this came about from a recent post talking about the Federal Reserve saying that it's going to eliminate this key lending rate called the LIBOR rate, the London Interbank Offered Rate, by June of 2023. And this is a rate that's probably more used across the world than any other rate. Certainly one that's used in a lot of derivative contracts. But it often leaves traders wondering if you're in a contract of some kind and the bank, let's say, or the credit card company reprices the interest rate. Are you going to be at risk of having to now owe more money? Or maybe will you get a windfall and owe less? Well, let's take a look at how this is handled. Let's say that you're going to borrow at 5%. So you borrow $1,000 and the bank says that it has a 5% annual compounding rate. That just means it's tacking on 5% at the end of the year. It's not doing periodic compounding. So that means at the end of the year, you'll owe $1,050. But now the bank announces midstream that the pricing method changes to compounded quarterly. So what does that mean? Well, if we take the 5% rate and divide it by 4 quarters, that's 1.25% per quarter that the bank charges. So now, instead of waiting until the end of the year to tack on the interest, it's going to tack on a quarter of that, or 1.25%, at the end of the first quarter. And that, of course, raises the amount that you owe. And then it's going to tack on another 1.25% the next quarter. So it's tacking on interest, so it's going to be a compounding effect. So now the annual rate mathematically works out to be 5.09%. So the question is, do your payments go up? And the answer is no. All that's going to happen is that the bank is going to say that your loan has been repriced at 4.91%. So how does this come about? Well, if we take the 4.91% divided by 4, remember that's the new compounding convention that the bank's going to use. That comes up to 0.0123% per quarter. So now what happens? Well, we just take this 0.0123%, we add 1 to it, and we raise it to the fourth. Mathematically, that's the same thing as multiplying your balance by 1.23%, multiplying it again the next quarter, multiplying it again the next quarter, and the next. We're just going to multiply it out 4 different times. And look what happens. That comes up to exactly 1.05%, exactly what your original terms were. So you still owe $1,050. See, the bank is just going to recalculate the terms of the percentages, but it's going to leave the balances, the ultimate prices that you owe, the same. So the idea to understand is that if you have a loan like this, we have the $1,000, the bank's new compounding rate is 5.09, sure, they could multiply that out and say this is the amount you owe, that it's increased. But mathematically, we can change other factors in here. They can't change the amount you borrowed, that's just a fact. But they can change this number to leave the ending balance the same. And that's really all that they do. So let's take a look at another example. For those of you who have had finance, know about a thing called continuous compounding. That's the absolute fastest we could ever be. If we compounded interest every nanosecond of the day for a full year, a 5% annual rate works out to be 5.13% continuously compounded. So does this mean that now your loan is repriced at 5.13%? No, they're just going to reprice it at 4.88. Why? Well, mathematically, we can take your $1,000 amount that you borrowed, and mathematically, we're going to figure it out by taking this mathematical constant E, and if you might know, 2.718, raise it to the 0.0488, and look at that, comes right back up to $1,050. So see, nothing really changes. The thing to understand is at the heart of all loans is how much do you need, that's the amount you borrowed, the principal, and how much are you willing to repay. That's really dictated by supply and demand. The rest is just an interest rate convention of how we can mathematically make those terms work out. So if the interest rate changes midstream, nothing really changes other than the way that they calculate the interest. So just remember, whenever you hear about interest rate repricings, assuming that you're already in a contract, that repricing an interest rate convention doesn't change the overall terms of the original contract. However, if the contract is rewritten, that's a different story. But we're just saying that you're in a contract, it hasn't been rewritten, but they just want to change their compounding or their interest rate conventions. Yeah, they could restate that in different terms, but the math can always be changed to fit the original term of the loan. So just remember, it's market forces that create the amount to borrow and repay, and the rest is just a pricing convention. For anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.